Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, August 11th, 5:23 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the Big Show edition, where we take a look back at the prior week and what an ugly week it was, especially for market leaders, and look ahead at the key levels for next week. Probably the only silver lining is that the S&P 500 continues to hold the 50-day moving average. Not a good week for stocks. So state of the market downgraded to weak uptrend, short-term caution. We've had short-term caution on here, but with the NASDAQ 100 breaking the 50-day moving average to end this week, and the decimation of the 21 over 21 list, can't really have anything green on here indicating that this is a market that you want to be putting a bunch of money into. But if you follow the William O'Neill principles and follow us at Revere, you pretty much already knew that. Let's check over here at the trend gauge. We downgraded last Friday, downgraded market leaders from bullish to neutral, now from neutral to bearish or downtrend. Uh, 8 of them knocked off, 8 of the 21-21 list knocked off last week, 11 knocked off this week. Tells me all I need to know. I will say there are still some decent set offs, some stocks coming off the 50-day moving average that we're interested in. If the market can right itself, we're getting extremely oversold on the indexes and on the RG8. In fact, we're at oversold, but that's not a reason to buy. We need some sort of a catalyst, some sort of strength to come in. Any attempted rallies this week failed miserably, and we'll go over that when we go through the index charts and the charts of what's left of the 21 over 21 leaders list. I don't even have a full 21. I want to go through a deep dive this weekend before fully updating it. So short term, the Dow Jones Industrial Average, which was the whipping boy of the big cap indexes for most of the year, continues its leadership, which really started 4 weeks ago when the NASDAQ started its latest weakness. It's still above the 21-day moving average. All 4 of the other indexes below the 21. And as I mentioned, on our medium-term time frame, 50-day moving average, still showing green arrow as we've got 4 of the 5 above the 50-day, but the yellow sub arrow indicating the weakness and showing the NASDAQ here below the 50-day moving average. Long-term, 200-day moving average, all fine for all 5 of the major indexes. And there's a lesson in here, and we detailed it a lot in the podcast this weekend. I put a chart up, an expectations chart, and talked a little bit about the evolution that's led us to have a big core holding of the S&P 500. We use the SSO and offset some of that with T-bill, some of the savings that we have by putting not the full 60% into the S&P 500. We can put 30% in and invest some of that difference in T-bills, which are yielding over 5%. But it certainly has shielded what would have been a very harsh pullback and we learned this lesson back in February of 2021 when interest rates broke out and growth stocks went into a stealth bear market that was hidden by what's going on in the overall indexes. And that's a little bit about what's going on now. Back then, the big cap tech names held up. They're not holding up now. They led on the way up. They're leading on the way down, but mid and small cap leaders have really taken a hit, and our signals did their job. We started lightening up and not putting more money into the market with some of the signals that we saw. If you review any of the videos over the last month, that'll confirm that. But we are where we are. The market oversold can stay oversold for a long time. We're in a very seasonally weak period. As good as June and July were, August has been that bad, and we'll see what next week brings us. But as of right now, any attempted rally, either in leadership stocks outside of a very few, and also on the indexes, has been muted because of the big techs dragging down the overall S&P 500. So what just happened today? PPI came in yesterday. CPI in line or better than expected. Today, PPI worse than expected, showing some inflation at the producer price level, and the index is gapped down on that. At 10 o'clock, consumer sentiment is big in the market. If people feel bad, they don't spend money. But consumer sentiment unexpectedly spiked up. We had a little bit of a rally after 10 o'clock, but it paused at near yesterday's highs around the 44.70 level. So really just a tight chop for the rest of the day. All week rally attempts failed, and again, NASDAQ 100, the loser on the day, on the week, and closing below the 50-day moving average. Here are the final numbers. RG8, this is our 8 ETF composite, down 0.38%. S&P 500 down, gap down 0.4%, closed down 0.11. But again, we put the low in early, but couldn't really make any progress throughout the day. NASDAQ 100 down 0.64%, Dow positive 0.3, mid caps just barely negative, Russell 2000 small caps just barely positive, Global 60/40 down 0.33%, both global stocks and global bonds weak, which means bonds being weak means interest rates ticked up again. That's terrible news for growth stocks. They just in a rising interest rate environment, growth stocks just don't do well. In-house protection down 0.18%. Most of it was NVIDIA continuing to sell off. We cut another part of our first three buys, which was before the big gap up, cut them for a gain in the 40%-ish plus area. And that's another one that's getting chopped off the 21 over 21 list. In fact, close below the 50-day moving average also. We'll hit the tail of the tape, and it's right now it's a 14 over 21 list. We had 11 booted off, 4 for sure that I added. We'll take a look at all those as we progress through the video. First, let's go to the S&P 500. This oversold on the daily looks the same for 4 of the 5 indexes and also for all 8 of the RG8. Oversold can stay oversold for weeks at a time on a daily. There's several instances on here where it chopped back in September of last year, in December of last year underneath. We rallied January and February, and then mid-February into mid-March, we chopped and stayed oversold, and we're just there now. No guarantee, or we don't know for sure how long that's going to stay. It could chop, which would be the worst case scenario. Best case scenario is kind of a rounded bottom like you saw here back in December, where we just kind of stopped going down, ideally right around this 50-day moving average here. So a nice rounded bottom that can kick off a leg to the upside, and then we'll see where that takes us. This was about a month long rounding uh, scenario back in December, taking us into the rally that kicked off in early January. Right now, the past 2 weeks of this has been just as bad as August normally is. So all we do is take it day by day. If you're an S&P 500 investor, this is what the pie chart guys trumpet all the time, and I'm fine with that as long as we're above the 50-day. But if we break down the way we did last year, they'll just continue to stay in there, and that's the difference between them and us. We won't do it. We've cut exposure all month, really, over the last 3 to 4 weeks, and like I say, it's not how much you make, it's how much you can keep, and we'll fight like hell to keep the gains that we made during the uptrend. So here you see us bouncing off of the 50-day moving average. Look at this 60-minute chart. I've been talking about this this 44.58 level, and we undercut and reclaim that today by the close. So that continues to be a pretty big level, and that's the breakout from 712, which we keep bouncing. It was 2 gaps. We filled both gaps now, and we continue to bounce at this 44.50-ish area, or continue to the bulls are putting up a fight there. Let's say that. But for one, two, three, four, five, six, seven, 8 sessions, we're just seeing lower highs and lower lows, and that's the definition of a downtrend. So in the short term, it's very clear what's going on. Also clear what's going on the Nasdaq 100, and it's not good. 50-day rolled, 21-day rolled over, continuing to act as resistance. The big gap up on Thursday ran right into the 21, promptly rolled over, and then a weekly close below the 50-day moving average. Not a good sign. You go to the weekly chart, clear close below the 10-week moving average also. And if you go to the similar 60-minute chart, this breakout area here that happened on the 12th, it's very clear that we've given that up. The next level down is right at today's lows, this 365 area, which was a semi breakout relative to what went on here in late June before we broke out there, back tested it, and had the breakout for sure on July 12th. But given most of that back up now, oversold very clearly. But as I said, oversold, can stay oversold, and relative strength confirming these price lows versus the last couple of weeks, but not relative to the pullback and where the RS line was back in late June. So you can see prices still above there, but the relative strength line is below there. That's a negative divergence from a relative strength perspective. If you look at this, you could say, well, we haven't broken down there yet, but as I just showed on the S&P, that's holding up above this breakout level. We haven't on the NASDAQ, and that's confirmed by the RS line. Let's go to the mid caps, MDY. 4 closes and a weekly close below the 21, still holding on to the 50-day moving average in oversold territory. IWM poked its head above the 21-day on Thursday, along with the rest of the indexes, still holding the 50-day and this breakout level at 189.24, also oversold. So those are the 5 major indexes. Let's go quickly to the VIX, which is back below the 21-day moving average, supposedly, or surprisingly, I should say. Under normal circumstances, making new lows on the index, you'd expect to be making higher lows on the VIX. But volatility really hasn't kicked up that much. It's kicked up mildly from like a 0.8 ATR on the S&P to the high 0.8s, but nothing like we saw back during the bear market, and below that 15 level, which is typically bullish. This is, I don't know why this is showing down 11.9% on the day. That's not accurate. It was down 6.4%. So it must have something to do with this. Obviously, this candle is flawed. Let's move to the dollar. Dollar up on the day, closing near the highs and near the high levels going all the way back to last December. So that's not a positive for stocks. How did it impact gold, silver, and gold and silver stocks? GLD flat on the day. Silver down slightly on the day. GDX gold stocks bucked the trend and were up 1% on the day. Let's go over to bonds. Bonds continue to see higher rates, lower prices, down 0.32% on the broad bond index. TLT down 0.23%. The 10-year was actually down more than the 30-year in price. So that represents the yield curve getting less inverted, which means we're not going into recession, which seems to be what the Fed is saying now, at least from some of the numbers that they're putting out, or at least a soft landing. But stocks seem to have done a front run on that data, and now we may be looking at what's going on early next year as the market tends to look 6 months ahead. Let's go to the 30-year yield. Not above last week's highs, but making a pretty big bounce up starting with yesterday's reversal to the upside on yields that hit the market and started the pullback after the morning gap up. TNX, the 10-year, not making higher highs versus last week, but a big 2-day bounce here, coinciding also with weakness in stocks. I didn't do Bitcoin. We'll do that real quick. Bitcoin basically flat on the day, and it's been trading in a tight 3-week pattern below the 50-day moving average. So those are all the major indexes. Let's hit the tail of the tape. You can pause this. I'll hit the highlights. Doing a point that stochastics, the Dow Jones is holding up okay. The other four are negative. All the RG8 are negative. The NASI, McClellan Summation Index, RSI, is negative. The dollar is strong, which is a negative. TNX and TYX near highs, that's a negative. Can it get worse? Maybe everybody's leaning to the one side of the boat on this, kind of the way they were. If you watch the podcast, Connor talks about that an NAAIM survey that we don't quote in here, but maybe we should start doing it, about how high the number of the portfolio allocations for active investment managers got. That also signified it went over 100 level. Definitely check out the podcast. We had some really good stuff in there, including that expectations chart that I put in there for what the expectations for our portfolios versus a bunch of different market cycles, and that's based on statistics of the past, and it's stuck pretty well with this recovery and this recent pullback. So definitely check out the podcast. We're on the bear case with the break below the 21, PPI above expectations. I mentioned that. University of Michigan 10 a.m. consumer confidence improved. We got a little bit of a spike on that, but we just really couldn't get over that high of the day level around 44.76. It's pretty clear if you take a look at the 5-minute chart here of the S&P 500. There's the gap down. We tried to rally 44.76, rally 468, and then several flirtations with 44.72. That's right, flirtations. They were like, "Hey, 44.72, how you doing? You look good in that dress," and couldn't get any higher, and then just unable to make any progress. So yeah, markets flirt with levels all the time, and that's how they sweet talk them. That's something I learned through the years. So day count, it's been an 8-day downtrend, just looking at from the perspective of lower highs and lower lows, and that's 8 days below the 80 EMA, 4 days below the 21 EMA. How about sectors? Oil's up on the day, gold stocks up, and then low beta, XLPU, VRE, staples, utilities, healthcare, and real estate up on the downside. Chucky continues to get smacked. XLC, XLK, XLY, that's communication services, tech, and consumer discretionary. Those are the three tech-centric sectors within the S&P 500, and semiconductors continue to get pummeled also. So what do we do in-house today? Added to Bros, some good standout strength since its strong earnings move. We sold QLD. That was our long position that we took in the Qs off the 50-day moving average. That failed. We sold a 4% position, down a little more than 3%. So very minor loss to the portfolio. And again, we trimmed a third of NVIDIA for 40+% gains. This is for clients that were with us from the beginning of the year. Anybody that came on after, I think it's March, April. We've been slowly adding NVIDIA, but those buys, we've given back most of the gains, and those were sold also today. Bottom line, our volatility adjusted beta dropped a little bit more from 0.97 to 0.86. What we have left in the portfolio, NRGU acting great. Nail, this is the home builder enhanced ETF. We're a little underwater on that. We're positive on TBT. That goes up with rates. DRV, we're positive on. That goes up with real estate going down. And then 3 individual positions, we're down to 3% NVIDIA, 2% Bros, 1% VRT. Bottom line for the week, the PPI gap down We tried a bunch of rallies all throughout the day. They all failed. And relative to the 10-week or 50-day moving average, NASDAQ 100 closed below it. S&P 500 held it along with the rest of the indexes holding it. Let's get to some charts now, and you can see what's been hammered uh, on the 21 over 21 list. So 11 closing below. Let's take a look at them. We'll start off with AEHR. Let's get back to the daily chart here. Yesterday, just reinforced to me, you don't want to buy strength in this market. This gapped up on volume, was having a great day. Then the market reversed strongly, and this has dropped from 51 all the way down to 45 and change in 2 days, closing below the 21-day moving average, just reinforcing that you do not want to buy strength in this market. And let me show you a close look, a quick look at the expectations chart that I showed in the podcast. A lot of good information in here, a lot of historical information in here. Basically, these are 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 market conditions and how we've historically performed and what our expectations should be in there. And one of the reasons why a lot of CanSlim investors, new ones, struggle is because they continue to buy breakouts when the market is undergoing a mild pullback or even a mild correction or a moderate correction. They're just a very low probability of going higher if you're not in a bull market. It's the M in CanSlim. There's, you can buy pullbacks during this time, and you can certainly buy them in a bull market, and we take advantage of it. But it's very cautionary trying to buy breakouts. They're really, for the most part, just not going to work. Obviously, there are exceptions, of course. But this is the chart that I showed in the podcast, and I went into it in a little more detail. So AEHR was the first one that was punted. Next up, DraftKings, DKNG. Nice attempted move out on earnings, and then we got a downgrade, and then Penn signed a deal with ESPN that was perceived negatively. This is a nice bounce off the 50-day. This is one of the ones that we're watching for a low risk entry off the 50-day moving average if the market rights itself. ITB, the home builders ETF, closed below the 21 for the first time going all the way back to late May. And another one that got punted off was Restoration Hardware. This has been a leader, obviously. And again, when you're in something and it rides the ADMA week after week after week, and finally it breaks, you got to take some of that profit and lock it in. And you can see what happens 2 days after breaking the ADMA and it rolls over. It's part of offensive selling. um, don't give back all your gains to the market. We use this rule a lot, and it certainly saves more money than it makes if we would ride it out. Not to mention the heartache that it causes watching your profits go bye bye. Speaking of profits go bye bye, Palantir is off the list also. With this nice 20% 2-week pullback, including a negative reaction to earnings. SYM, another a robotic stock, had a massive 50% gain in one day on earnings, just gave it all back over the last 2 weeks. That's off the 21/21 list. We got stopped on that last week. Okay, so that's 1, 2, 3, 4, 5, 6, 3 more, 5 more actually. FCX breaking below the 21. This looked like a nice shakeout day for commodities. Oils have continued higher. FCX did not, closing below the 21-day moving average. ON shakeout back here, tried to make higher highs. Don't buy breakouts in a market like this. 2 days, negative reversal, closing below the 21, earnings in 4 days. Shake Shack, good reaction to earnings initially. Don't buy breakouts, got above that 80 level and now gave it up the last 3 days. Still one we're watching off the 50-day moving average after this positive upside reversal. It got a downgrade this week, which was partially responsible for some of this pullback. but their numbers are pretty good, and it's holding the 50-day moving average. That, along with DraftKings and Uber, which came off the list last week, are three that we're watching around the 50-day moving average. Hate to say it, but Nvidia came off the 21/21 list and broke below the 50-day moving average. And it seems like anybody that bought this after the gap up is for the most part even. And if you don't have a cushion to go into earnings, which are in a little over 2 weeks, uh, and look at the size of those red bars, it's just a lot of selling in Nvidia. Um, the bloom is off the rose for the time being when it comes to AI related stocks. And SMCI, we got stopped at 303 after hours on our last 1% size on this, on a very negative reaction to earnings. Uh, terrible, terrible week for this stock also. And those are the 11 that got punted off of the 21/21 list. So that takes us back down to 10. And I've got four that were added, and we'll go over those quickly, and then the 10 survivors from last week. We'll start off with ELF. What a run this has had. Let me take off stochastic so you can see this a little bit better. Just an absolute model book stock, keeps gapping up on earnings and then just continuing to go higher. One we got stopped out of here and also here. Uh, just looking back with regret on that, and we had a shot to buy it back here on this pullback to the 100 level, and for whatever reason didn't do it. But um, we don't pretend to get them all right. We show our warts here all the time in these videos. We just believe in being transparent. It's not a bed of roses. What we do is tough. Axon, the formerly known as Taser, another situation where you can go from a great earnings report one quarter to a terrible earnings report the next quarter, back to a fantastic earnings report this past quarter, making a day three higher high on this. So Axon also added. DRV, this is the inverse real estate sector. So we're using the underlying of XLRE for this. And when this wedged up and failed yesterday into all these moving averages and then rolled over, we took a small position in DRV, and it's working so well. Small gains on this will handle this based on the chart of XLRE. If it shows strength, we'll be out of this. But with interest rates rising, XLRE does not seem like a good bet. And Bros, we bought this week on its big earnings gap, massive volume, 790%. Higher close on day three. Needs to get over this 34 level decisively. You can see the resistance back there around the 34 level from February, from April, and from May. Poked its head above it today, but couldn't quite get there. This is an example of not buying strength, but buying a consolidation after the initial strength goes. It's not a breakout. A breakout would be the equivalent of buying this above 40. We're nowhere near the prior highs. This is where things get smacked down. This one has a chance. We got a pretty decent entry point here with a very low risk stop out below the 200-day moving average and below the 32 level. So Bros, the fourth one that was added. These are the leftovers from last week. NRGU, broad, Big 10 leveraged, 10 big energy charts, fantastic relative strength over the last 4 weeks. Just keeps trudging higher. Bunge pulling back after its earnings report, agricultural operations, and chemical stocks, a few of them improving on their charts. LNG Cheniere, Mike loves this. He's investigated the story deeply. He's got a big personal position in this. We haven't bought it yet, but we're watching it. EXTR, Extreme Networks, one of the only sectors that continues to work well is anything having to do with data center components or data center buildouts, and Extreme Networks fits that bill. Also on the podcast this week, Ted talked about Two tickers that are remaining here, we'll get to them quicker. We'll get to them soon. He gave some nice details on what they're doing and why they continue to hold up. And one of them was VRT. You can see the big gap up on earnings, pulling back now to the 80 MA. And VICR, this is the other one that he talked about, massive move up on earnings, pulling back now on lighter volume into the 21-day moving average. Boeing continues to act well after its breakout on earnings. TBT, this goes, excuse me, this goes up as interest rates go up. It's the opposite, the two times opposite of the TLT. Tidewater, another oil stock, continuing to hold up very well, had a shakeout on earnings, great relative strength, and Weatherford. So guess what? We've got 4 oil stocks in here, 2 networking stocks. And that pretty much tells you where the money has been flowing lately. Weatherford making a new high, and those are the remaining stocks from the 21 over 21 list. I'll update the list over the weekend. Check back Monday, and you'll get the full 21 over 21. I know there's a bunch of them still out there, but I wanted to spend some more time to get the best of the best. And with that, I'm going to wrap up this week's big show. Reminder: it's not how much you make in the markets; it's how much of that you can keep. You're interested in contacting me, email don@revereasset.com. On YouTube, leave a comment. I respond to all of them. Please click the like button. We appreciate that, and it improves the algorithms for getting our work out there so more people can see it. And if you want to reach out and talk to Danny, it's either dan@revereasset.com or call 855-REAL-WEALTH. That's 855-732-5932. And that's going to end it for the week ending August 11th. This is Don Vandenbord with Revere Asset, telling it like it is. Not always good news, but it's the truth. Thanks for listening, and have a great weekend.